Hey Josh, good morning.
Good morning, man. How's it going?
Pretty good, pretty good. Sore from CrossFit, but that's kind of become the usual.
Yeah. It's kind of funny. We both started doing CrossFit at the same time and been talking about it. So it's kind of been fun to have someone to talk to about that.
Yeah, absolutely. Especially somebody who like went in, with a fairly good amount of physical fitness and still got humbled, like
Oh
I
yeah.
did.
Yeah, I my Achilles tendon is like an overhead squat. That motion for me is I can't do it.
Yeah,
Can't do it yet. I will get it sooner or later, but yeah, that's been one of my most challenging and humbling exercises that I've been working on. So
I feel
I'll get
that.
there. So, well, yeah, well, on the let's just talk about commercial real estate returns and kind of how
Okay.
that looks because I think it can be a little different than most people think. So let's just break it down just really simply and just share how that looks.
All right. Well, simply, I'll do my best. All right. So, when I was studying real estate in law school, one of the things that really stuck out to me was that real estate's a unique asset because you got three bites at the apple to make money on real estate, right? So the first one, the one that gets the most press, is cash flow. And cash flow, everybody wants like cash
Oh
flow,
yeah.
especially in the world that we live in with low interest rates. And cash flow is very simply your top line, whether your gross rents minus your expenses. And those
Mhm.
expenses can include, operating expenses like lawn service, snow removal, taxes, insurance, and then also the debt pay down. What's your mortgage on it? Because one of the great things about real estate is that banks are usually willing to lend on real estate.
Yeah.
And so then that gets you to your cash flow, right? So your top line rents minus expenses and debt pay down. Boom, cash flow. Well, as interest rates have come down, that cash flow level has also come down quite a bit. But that's the story doesn't stop there, because the other great place that you get return in in real estate is with internal rate of return, and that IRR is a term that you see quite a bit in here. Let me share my screen so I can.
I think a lot of people have heard that, but don't
Mhm.
quite understand what it means, like
Yeah.
even me, it's like in the beginning I was like, I get this and how does this, but I get it, but it's confusing, you know what I mean? So,
Mhm.
um, but I think this is where most of the magic lies is in these internal rates of return.
Oh,
And
100%. That's where a lot of your juice comes from.
yeah, because
So this is, you should see my screen here, but this is a real building that we're doing underwriting on. And so cash on cash, that's the cash flow that we talk about. And so this is the net yield on the equity investment. So like with this one, let's say you're putting in, $1 million of equity. This means that when, after all the debts and expenses are paid, you end up with about a $20,000 of annual cash flow, right? So that's what that number means. But this internal rate of return, it gets a little bit more complicated in a good way, because every month that you're paying off your debts, you're paying on your loan, you're paying off some portion of principal. Well, this formula says, okay, based on what we know about the way that the loan works, and we extrapolate out, in this case, over a 5-year hold period, what does that look like? So in addition to the cash flow up here, you also get this, essentially 9% rate of return on your equity invested in the building.
mhm.
And like, that's fantastic. I mean, where can you get a 9% yield? Nowadays, certainly can't get it in a CD, can't get it in life insurance,
Yeah,
can't get it in a bond.
no, for sure.
And so this is where, this is why I am so bullish on real estate as an asset class, especially in a high inflation rate environment like we're in now.
Yeah.
And at the risk of being a late night sales sales commercial, but wait, there's more. Yes, I've been waiting. I'm dying to say that actually. There's also this return
I can
on
tell.
Yeah, yeah. I was thinking about that like in the shower this morning. Um, but then wait, there's more. There's also the return on equity because I mentioned that right now we're in a high inflation environment, right? Well, as a result of that, the value in dollar terms of the land and the building, especially the rebuild value, go up. It's just math. If
Yep.
if inflation's running 10% a year, that means that that building would theoretically cost 10% more per year to rebuild. Now, our models use a much more conservative approach, but like on this building that we're underwriting, when you add in the cash flow plus plus the debt pay down, and then you add on top the appreciation, expected appreciation of the land and the building, you get about, in this case, 14% year over year over year on the equity in this
Yeah.
particular high quality, publicly traded commercial tenant.
Yeah.
And so those are the three primary ways that compounding in real estate works.
So
And it's a supposedly Chinese, but I heard it on CNBC. But the phrase was the best time to plant a tree was 20 years ago, and the next best time is today.
for sure.
And I think the takeaway of that is with real estate, if you're compounding, at 13, 14, 15, 20% a year, time in the market is significantly more important than timing the market. So just
For
my
sure.
2 cents on where those
Yeah.
returns come from.
So just to recap, so cash on cash return of that 2% is the cash flow, correct? So you
Yep.
have cash flow. The internal rate of return includes the debt pay down. So that'd be number 2, debt pay down.
Yep.
So as you make your principal payments every month, you're gaining that equity, which is coming from the tenant. So it's a direct return to you, which is pretty amazing if you think about it. You know what I mean? Someone else is paying off a property for you, and you get 100% of the benefits of that.
Mm-hmm.
We haven't even got to talking about leverage, but that's for another day. And then return on equity is the appreciation. So those are the 3 things that we're talking about here. And I think everyone can understand appreciation, especially today,
Yeah.
with the way home values have gone and the way the market is going, that everyone sees it. And, and so it's undeniably, obviously, part of real estate as well, and especially over the long haul, So
Yeah.
awesome. So that is pretty much the returns, huh? Would you say?
Absolutely. Yeah, those are real estate returns in a nutshell. But those basic concepts, drive pro formas. Those are what banks look at. Those are what we, the investors, look at. And at the end of the day, this is what we're going for, because everything's relative.
Yeah. And I will add that there is one more thing that we don't talk about, the benefit of real estate, and that's depreciation. That's probably that's more of a tax thing. So it's not necessarily a gain, but a savings, maybe, if you will. So
Actually,
definitely dive into that.
Yeah, the magical thing about depreciation is you can have situations, especially with interest rates where they are, you can have a situation where you actually end up making money on the building on a real basis, but because of depreciation, you don't actually pay taxes on it.
Yeah, so like tax-free money, and then add that to the returns on top of that. And that's a different situation because that's more investor specific, but you add that, the returns are actually more than that.
And that is one of the reasons why virtually all high net worth individuals and investors have at least some commercial real estate exposure in their portfolios. I mean, it's just one of those core asset classes that isn't as sexy as other asset classes, but it's slow and steady and works its magic over time.
For sure. It's a very passive asset class too. So, Well, hey, thanks for your time. I know you got to get going, but thanks for breaking that all down and kind of shedding some light on what those return on equity means and internal rate of return. It gets kind of confusing, but yeah, that explains a lot more. So appreciate your time today, Mike.
Absolutely. Anytime. Look forward to talking about this again.